From the morning reading, 3 white soldiers march back to resistance. The spiders and diamonds are near the recent high. MU reports after hours. All 9 sectors moved higher on Thursday. XLP, XLU, and XLI were the strongest sectors, while XLY was the weakest sector for the second straight day. Oil futures fell $1.14 to close at $48.40. Breadth weakened as advancers led 2405 to 644 on the New York Stock Exchange and 1839 to 787 on the NASDAQ. The stocks jumped again, triggering a third large up day in a row. Back-to-back gains of 1% have been rare, especially coming after a multi-month low. When it has done so, the S&P 500 has been higher 3 months later every time, though the sample size is small. The 3-day push triggered a new quarterly closing high in the S&P. That's the indice's first new quarterly record in the last 4 quarters, an event that has tended to lead to further buying momentum during the next quarter. The buying thrust pushed a lot of securities to the 52-week highs. Nearly 400 issues on the New York Stock Exchange closed at a new high, the most in more than 2 years. When the number of new high jumps to the highest level in years, stocks have tended to relax in the shorter term, but show gains in the medium term, especially when the S&P was relatively close to a 52-week high itself. Despite the gains, there are signs of skepticism. Fund investors pulled money from mutual and exchange-traded funds this week, continuing the 2016 trend, and option traders continue to heavily favor buying put protection versus speculative call options. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6 a.m. Mountain Time, and I'm recording this in preparation for the market day of July the 1st, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and get into the morning report. There we go. It for the 4 U.S. broad market indices is mostly a story of scratch. All 4 of them are plus or minus just barely wrapped around scratch coming into today. Crude oil is down about 1/3%. Euro's up about 0.5%. Bonds have moved though. They're up over 1.33%. Gold is also up sharply, nearly 1.33%. In overseas action, you have China just above scratch. Hong Kong was not open today. Japan up about 0.2%. Germany up about 0.2%, and United Kingdom as well. In terms of U.S. focused macroeconomic reports of note for today, you have final manufacturing PMI, ISM manufacturing PMI, and then a number of smaller reports that shouldn't be market movers. In terms of current volatility conditions, obviously things have been coming down dramatically with, as one morning author mentioned, we have had 3 white soldiers in our candle pattern, a very bullish combination, and the short-term VIX is now down to a 14. Skew still elevated, actually went up with yesterday's numbers to a 140.58. IV percentile across all 4 of these has been falling. S&P down to a 16, Russell to a 24, NASDAQ to a 16, and Dow to a 13. We continue to pack on the standard deviation moves, and for the Russell, this is 6 trading sessions in a row with the standard deviation move. Interesting, 4 of those have been up, 2 have been down, but the 2 down were so severe that you still got work to do to get back to where you started. In terms of yesterday in isolation, all 4 of the broad market indices were up over 1 standard deviation. A couple of these were actually close to 2 standard deviations, but not quite enough to round off to a 2. In terms of the current charts, let's start with the bonds because that seems to be the story in the overnight. These are the bond futures, and you note that we've had a series of breakouts. And while sometimes you have to kind of be patient to see when that breakout is going to next occur, it eventually has occurred all throughout these recent months. We had this big ascending triangle pattern, which eventually broke out here on June the 3rd. And then another bull flag, and you know, that's a pretty long time there for a bull flag, but then it broke out. Of course, that's related to the Brexit vote. Again, a consolidation, and now another bull flag breakout. So right now, this thing is, and I guess we'd call that a bull flag breakout. You could also call it a horizontal breakout. But bottom line, big move in bonds in the overnight. So this is plowing into new all-time highs here. So very, very significant. In terms of the S&P, very quiet action in the overnight going into our first day of the month. Normally the first day of the month is seasonally bullish, and going into the 4th of July Independence Day holiday, that's also usually bullish based on the last 10 years pattern. So the expectation is that probably a bit of slight bullishness to the day, though after especially lunch, probably have a lot of traders heading to the beaches, New Jersey and so forth, and the Hamptons, and they will likely be very light trading volume going into the afternoon. So just kind of be aware of that. If you're an all-day trader, an active trader, signals could get kind of choppy and little follow-through in the afternoon session. In terms of our activity here, we've clearly broken past the 618, so the opportunity for this thing to turn short from the usual retracement area has been run over, and now that we're up past this area, the expectation is that we should go back to the former swing high. Now that former swing high, of course, is a very important swing high, and that's the famous area of resistance that we've been talking about for months. And once again, and we'll look to see if this is going to be a third trip into the same general area in a relatively short period of time. Is the third time the dream time, and we finally break through this area and actually accomplish something? So that would be quite remarkable, given that we had this huge breakdown with the Brexit vote, but then also the huge reversal. So it's and the short-term patterns, this is pretty unusual in so many different ways. It's hard to fully comprehend. So let's go ahead and go to the cash market. Let's see if that looks any different. And you see on the cash market, just about back to where you started. In terms of the Dow, very, very similar pattern. We continue to have very tight correlation between the Dow and the S&P. NASDAQ, the thing that's a little bit worrisome here is that we continue to have these lower swing highs, and we haven't taken that out. We've not even gotten back to the former swing high of yet. But obviously the same kind of three white soldiers kind of pattern here that you have in the other indices. The Russell, very strong short-term bullish pattern, but again, lower swing highs, the last couple important swing highs. So where does this one take us to? Crude oil has been in a very, very tight correlation up until recently, and then crude oil has gone into this sideways consolidation pattern. Hasn't broken down, but it also hasn't achieved any new highs. It's broken out of that channel into this sideways consolidation pattern, and waiting to see which way this breaks. If it does break up, that certainly will be a boost for the equities. Gold, of course, has been the safe haven, and it looks to be breaking out of its own bull flag pattern today. So it and bonds would seem to call into question that equity should be plowing higher. These safe haven areas are doing well in the overnight going into today's cash market, and yet equities are still at scratch. And then let's take a look at VIX, and that should wrap us up. The VIX vol crush that we've been talking about has been absolutely in play. That is certainly supportive of the equities moving up. And you see the regular VIX down, into the 15 handle. Wow, how fast that vol crush took place. Let's go ahead and move to the daily report. There we go. We do have a couple important changes on the daily report today. First of all, let me mention about this market trend intermediate term phase opinion. I still have this as market phase 5, which is a bearish phase. It's the, in quotes, the end short term, the break of horizontal diagonal support. Obviously, that was just a few days ago with the Brixet vote that we had that huge breakdown and we flipped into market phase 5 on that phase opinion. We've made a lot of ground up, but we haven't really quite taken out resistance yet that would be needed to be able to, kind of capitulate this market phase 5 into something that's a bullish phase. Normally, we like to see a market phase 5 be in a pattern for a couple weeks. So a couple very unusual aspects to the current short-term trend, which are perhaps muddling up this opinion. And this one is, there's a little bit of an opinion here in terms of determining which market phase you're on in this section. So this one's not as cleanly mechanical as the market timing signals are that we go to next. But anyhow, I did want to mention that while this is still bearish, there's certainly, you have to respect the fact that there's been a lot of bullishness in recent trading sessions, very strong bullish activity, and that this may be ready for a change in the next session or two. But in the market timing signals, we definitely have had a change. And for one, with respect to the IBD, a very rare 3-day flip to confirmed uptrend after going to market and correction. Let me just comment a little bit on that. The 3 days of strong price gains are with above average volume, and this constitutes a rare day 3 follow through. And I'm picking up some content from IBD talking about this. A follow-through signal that the market is in an uptrend. That's a signal to investors to increase exposure to stocks. Meanwhile, additional positive developments have also emerged. The S&P 500 reclaimed its 50-day moving average after retaking its 200-day line on Tuesday. The NASDAQ climbed above both lines Thursday. So what sort of stance should be taken after this quick U-turn? Although quality stocks breaking out of solid chart patterns can be bought, individual investors should exercise some caution for several reasons, and they go into several here. First, a day 3 follow-through is rare. The most previous case was December the 16th on the S&P 500. However, 2 sessions later, the uptrend was back to under pressure, a bearish market timing signal. All uptrends include a confirmation, but not all confirmations prove accurate. Second, the charts of the major indices are just plain ugly. Action over the past 3 weeks has been wide and sloppy. It would be best if the indices would now begin advancing in a disciplined fashion. Third, follow-through days in June and July have a history mostly of failure. August, however, has historically been a better month for successful bullish signals. And then fourth, the long-term price action picture cries out for caution. After setting a peak at 5231.94 last July, the NASDAQ has been in a rolling, choppy descent for 11 months. Lower lows were pegged in August and February on the NASDAQ, and lower highs on the NASDAQ have ratcheted resistance down from the 5200 area to around 5,000. Does that sound like a bull market to you, is the question from the author at IBD. And I most full-heartedly agree with that analysis from IBD. We've been talking about this sideways choppy trend. It's very hard to be anything but skeptical, as another morning author mentioned, about the ability of these bulls to be able to get through this area of resistance. So these mechanical signals that are being issued right now, while very, very helpful, you have to also put everything into the big picture and take all the information into play and be able to discern when are mechanical signals likely to have problems. And much like a moving average crossover system that many of you probably have learned with your trading, like a MACD or just simple moving average crossover, if you're in a sideways market, you get lots of signals going back and forth, as that sideways market, isn't the best for a moving average crossover system. With the same thing here with the IBD confirmed uptrend, when you get a sideways market, we've had many signals now in the last 18 months where they've been no follow-through either to the bull signals or to the bear signals. And this, with just a 3-day turnaround, is even more suspicious. In terms of the second market timing signal, this one also is at a turning point. It's improved dramatically to a 5 out of 6, and to the more sensitive GMI 2 to a 7 out of 8. It's still technically on a sell signal, but probably on the verge of tripping back to a buy signal as well. That author has been into cash in the last few sessions. So, also some whippiness in this signal here. Now, in the third mechanical signal, this one's a bit more specific, so we can dive deeper into this one. This one comes, of course, from Stock Chart's Decision Point Scoreboard, and they break it down into short, intermediate, and long term into the 4 different indices, as it were. And you see the short term, none of these have turned yet. We're still all neutral to bearish, and we still have the recent 2 signals on the NASDAQ neutral to bearish in the intermediate term. Now, the rest of the intermediate term still holds as bullish, and this is all against a backdrop of mixed signals on the long term. So what do you make of all this, and what do you do? Well, I would say that the consensus of these signals right now is a market in transition, and until you get a real definition, you have to remain cautious and somewhat defensive. And what do you do with that? Well, certainly while the mechanical signals that come from our position sizing opinions are now back to 100%, you look at the intermediate term market posture, and this is one of our strong determination signals as to what we actually do in terms of engagement and the initiation of new trades. Well, all 4 indices are still in a strong bear intermediate term market posture, and that's supported by a weekly bearish sentiment line. So you got some of these short-term signals that have started to go bullish, but it's against a backdrop that's really quite mixed, and this intermediate term market posture is a real problem. Now, this could turn back up to a weak bull with another strong session or 2. And, as these things start to line up, we start to gain confidence in the initiation of more positions. I have changed the hedge warning status down to a level 1+. It was level 2 going into yesterday. So this is starting to ebb. It's down to a caution light. It's still an elevated risk level to the market. We don't want to get out in front of ourselves and say, oh, well, 3 white soldiers, that's bullish, and let's just buy everything in sight. That is not the kind of market that we are in. Now, I will recognize the VIX is acceptable for option income strategies. I put on a Rut Bear Butterfly yesterday myself, which is slightly bearish, but option income strategy. So that certainly fit the current market conditions where I'm doing option income, and yet at the same time I'm using this strong bullish activity with some skepticism to set up a slightly bearish trade. The same thing with covered calls and put selling. We've now flipped to conditions are acceptable to initiate new positions for novice traders, but then still being very defensive in how those are constructed. So if you do initiate something, you might want to, not go all in with a whole bunch of positions, but go in with a few positions at a time and gain confidence as the market shows strength and follow through. The other thing is, of course, using this very defensive setup of in the money and out of the money strikes, a 2-to-1 ratio, and then also going with lower beta. And as we talked about with the sector specific, telecom, utilities, and consumer staples, they've been the consistent performers across all the different time frames. So consider that for your cover call and your put selling strategies. In terms of specific warnings, there's a lot more black here. Things are resolving and going back to their normal status in many of these things. We still have this market in decline. But a lot of these things have turned back to black. We still have an elevated skew. We still had that market phase 5 and that strong bear, but we also had at the same time in New York Stock Exchange new high, new low for the 1 month, full out over 300, bullish signal there. On the key intermarket risk aversion indicators, here's another one of those kind of, sticky wickets, as it were. They're still all 5 as risk off, though the bottom 3 are showing signs of rolling up, have not yet crossed. In terms of sentiment, very, very neutral. And you see the fear and greed index has gone from, just above the neutral zone into slightly into the green zone. Sector specific, just about a sea of green, but I would caution you, this isn't as bullish as it might seem. Many of these are in sideways patterns, much like those market timing signals where we're getting whipped back and forth between red and green, as the market, makes each move on this range-bound activity. Consumer staples, utilities, and telecom are the 3 that you see that are green across all the time frames. That's probably the biggest thing to point out with this last chart at this time. So we're about 22 minutes. Let's go ahead and wrap this up for today. I'm going to scroll through to our disclaimers. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink at the bottom for the full set of disclosures. And then finally, I will mention that obviously Monday is a trading holiday. It's Independence Day for the U.S. market, so activity will be non-existent in the regular cash markets, and then there'll be some futures activity, but abbreviated. So keep that in mind. Really, markets will close this afternoon and then reopen on Tuesday, and you will also likely have very light volume this afternoon as many traders head out for the long weekend. So trade well, trade smart, trade with a idea of risk management always. And in the meantime, we'll see you back here for the next trading session from Falcon Global with the market preview. Good trading.